So you've decided you'd like to find out more about equity crowdfunding. Great. Grab a pen and some paper. We're now going to help you evaluate each idea you come across as an investment opportunity. A Nesta study found that angels who do their due diligence properly experience significantly fewer failed investments, so it's important to do your homework. Based on our research and discussions with professional investors, we've developed a basic framework covering 4 areas: team, market, product, and financials, to help you evaluate each idea you come across. Analyzing an investment opportunity is a very personal and subjective process. Different investors analyze different opportunities in different ways. You should find what works for you based on your personal preferences. 1. Team. All angels agree that the management team is extremely important to any business, irrespective of how good the idea is. Typically, angels like entrepreneurs who have started a business before, bonus points if it was successful, have specific industry experience, are committed to the business, and have skills across the necessary functional areas such as marketing, finance, and sales. Make sure you dig deep to find out as much about the team as possible. Follow the founders on Twitter, check them out on LinkedIn, do some Googling. These days, you can find out a lot about a person just by looking online. 2. Market. For a company to make money, it needs to appeal to a sufficiently large market. Large market equals large opportunity and more emerging niches where someone can become a leader. Take a look at the market for the investment opportunity you're weighing up and ask yourself, how large is the market? How competitive is it? What are the major barriers to entering that market? And how much of the market share does the company plan to gain? 3. Product and business model. Most ideas focus on either a new product or service, or a new way of doing business, or both. A good example is the iPod and iTunes. MP3 players already existed when the iPod was first released, but what Apple did was to bring it to market in a revolutionary way, combining the iPod with music purchasing through the iTunes Store. When evaluating a product, you need to look for defendable positions. Do they have any legal protections through intellectual property or contracts with key partners? Do they have a disruptive or truly innovative business model? Does their product or service solve a genuine problem for customers? And finally, do they have a clear plan for how to find and sell to those customers? 4. Financials. Our final area for evaluation is financials. This doesn't necessarily need to be complex. Make sure you understand how much profit the company makes. Businesses are expensive to run at the startup stage, so look for over 50% gross margin. Have a close look at the cash flow projections. Has the company clearly described how much it will be spending, the burn rate, and how much it intends on bringing in as revenue? Is the business scalable? Does the company have an exit strategy? This usually involves sale of the business, so work out how much the company plans to sell their business for, and how much you would make if they succeed. Now that you have each of the 4 areas, team, market, product, and financials, look out for higher quality business plans. Feel free to add to or remove from this framework once you've tried it out. It's important to judge for yourself how accurate you think a company's business plan, forecasts, and ambitions are. Watch the next video to find out about investment terms, which are vital for you to understand exactly what you're buying into.